Despite an uptick in volatility over the past couple of weeks, it's been another slam dunk year for the stock market. 2022 is shaping up to be a difficult year for the stock market as the Federal Reserve prepares to make a policy pivot. Bank of America said in a note on Friday. Investors shouldn't expect the near 20% year-to-date gains in stocks to repeat next year due to a rates shock that will occur when the Fed is forced to raise interest rates sooner than expected, according to the note. So in this video, we're going to tell you about is the stock market crash coming in 2022? The video is going to be amazing, so make sure you stick to the end. Before starting the video, be sure to smash that like button and subscribe to never miss out on any of our videos. Although Congress enacted trillions of dollars in pandemic relief programs, those are expiring. The result will be a radical downshift in income growth for pretty much the whole country in 2022, says Brad McMillan, a chief investment officer of Commonwealth Financial Network, an advisor and broker-dealer. Despite considerable challenges posed by the Omicron variant and ongoing inflation surge, a majority of Wall Street firms predict the stock market will continue to rally next year, albeit modestly thanks to the strong corporate earnings, solid economic growth, and easing supply chain issues. During the early weeks of the pandemic, the stock market was in an absolute free fall as economists feared the COVID-19 recession could slip into a depression. By late March 2020, the S&P 500 index was down a staggering 31% from the month prior. It didn't last long, even before the lockdowns ended last year. The stock market and economy both kicked into a speedy recovery. In fact, on paper, it's one of the fastest rebounds on record. The rally was so strong the S&P 500 index ended 2020 up 16% on the year. That run, at least for many non-tech stocks, has carried over into 2021. This constructive outlook is based on robust projections for economic growth in both real and nominal terms, further margin upside in cyclical groups, a pickup in buybacks, and a favorable discount rate despite Fed tightening. Golub wrote in a note. Through 11 months this year, the S&P 500 index is up another 21.3%. For comparison, the average return this century is 10.6% per year. But where is the stock market headed in 2022? Analysts at the firm are among the most bullish on Wall Street, predicting the S&P 500 can reach 5,300 by the end of 2022, amounting to 15% upside from the index's current price of 4,600. The bank believes that investors are too focused on inflation, which should moderate as supply chain kinks get straightened out next year. Combined with solid corporate earnings, that should continue to drive stocks higher in 2022, BMO analyst said. What's more, the size of the Federal Reserve's balance sheet will remain very large for quite some time, which should continue to be supportive of stocks. Over the past couple of years, the cryptocurrency market has run circles around the S&P 500 since the coronavirus trough. For equity markets in March 2020, the S&P 500 is up a little over 100%, whereas the aggregate value of digital currencies has soared more than 15-fold from $141 billion to $2.34 trillion. Making money in the cryptocurrency space has been easy, perhaps a little too easy. Crypto gains have, in some instances, been invested in highly volatile stocks, momentum plays, and meme stocks such as GameStop and AMC Entertainment. If the crypto market, which is dominated in market cap by a handful of names, were to undergo a significant reversion, the capital retail investors have been bouncing between digital currencies and volatile momentum meme stocks could partially or fully dry up. As a reminder, in November, the Federal Reserve's Financial Stability Report cited the actions of retail investors in meme stocks as a potentially destabilizing factor for the stock market. If momentum chasers are clobbered by crypto in the upcoming years, Wall Street will likely share the pain to some degree. We would reevaluate this positioning should the yield curve flatten further, nominal growth fade, or earnings trends reverse, Golub wrote. We're downgrading financials and healthcare to underweight on weaker growth prospects in 2022. Markets look through surging prices this year, and for good reason, as soaring corporate earnings prove that companies can pass on higher costs to a consumer that remains willing to spend. If inflationary pressures ease in the coming months, don't expect a relief rally, as that's what stocks have priced in. Having had its transitionary inflation cake in 2021, the market may not get to eat it again in 2022. Goldman Sachs Group Incorporated strategists Dominic Wilson and Vicky Chang wrote in a note. Should price pressures persist or even intensify, things could get tricky. Stocks are only a good hedge against inflation up to a certain point, which Auto, BHF, Wallace Beth, Capital, and Lombard Odier put at 3% to 5%. Sustained price growth beyond 4% would erode profit and harm stocks, according to Florian Lelpo, head of macro and multi-asset at Lombard Odier. High inflation would also pressure central banks to tighten policy, thus raising borrowing costs for highly indebted countries such as Italy and draining market liquidity. Federal Reserve Chief Jerome Powell drew first blood this past week, warning about the possibility of faster tapering of asset purchases to keep the economy from going into a tailspin. The Fed last year cut its benchmark interest rate to near zero and began large purchases of government bonds. Bond yields moved the opposite way as bond prices, so the buying depressed yields, making it cheaper to borrow. But inflation in recent months has been hanging around 5% annualized, and although Fed officials says that pace will slow, they've announced a tapering of bond purchases. Markets also expect the Fed to raise its benchmark bank lending rate twice next year, perhaps by a total of 0.5 percentage points, further tightening policy. These steps would remove a large amount of liquidity from the financial system, says Steve Sosnick, a chief strategist at Interactive Brokers. It remains to be seen how the bond market reacts, he adds. But in recent months, rises in bond yields have sparked selling in equities. A threat to the stock market in 2022 is leverage. Over time, we'd expect the nominal amount of margin debt outstanding to rise. Margin debt describes the amount of money being borrowed from brokerages with interest to purchase or short sell securities. However, rapid rises in margin debt are far less common and come with worrisome implications. Dating back to the beginning of 1995, there have been only 3 instances where margin debt climbed at least 60% on a year-over-year basis, according to data from the Financial Industry Regulatory Authority, FINRA. It occurred shortly before the dot-com bubble burst, just months prior to the financial crisis, and again in 2021. While margin can be used to magnify gains, it can also quickly multiply losses. A fear or sentiment-driven short-term event that pushes the S&P 500 lower in 2022 could lead to sweeping margin calls that sink Wall Street. After recent gains, the S&P 500 has a broad valuation of around 22 times 12-month forward earnings, 30% above the average of the past 2 decades, according to Mr. Stovall of CFRA. Investors tend to ignore such flags when underlying conditions are favorable, and there's a lot of willingness to take the risk. But next year, with inflation possibly lingering and the Fed draining liquidity from the economy, investors may decide that stocks are overly expensive, says Timothy Murray, a capital market strategist at T. Rowe Price. The market also may prove less resilient in the face of new shocks, such as the possible emergence of a more virulent version of COVID-19. Though there's no way to know when this dip might occur, history is pretty clear that downside moves are a normal part of the investing cycle. In other words, don't be surprised if 2022 features a bigger dip than the minuscule 5% drop the S&P 500 contended with this year. So far this year, the S&P 500 is up 25%, but when analysts track how the market has fared on a rolling basis in past decades, the data shows that strong stretches usually are followed by more lackluster periods, says Mr. Stovall of CFRA. Based on how the market has been doing recently, the odds favor a gain of perhaps just 6% in 2022, he says, but despite the bleak outlook for 2022, investors shouldn't sell their stocks just yet. Instead, investors should wait to sell the stock after an expected year-end rally due to already bearish investors' positioning. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Don't forget to subscribe to our YouTube channel. Stay safe, and we'll be back with you in another video. And stay safe and be happy.